Happy Tuesday out there, folks. This is Darius Dale here to present our macro minute for Tuesday, May 17th, 2022. Starting with markets, we have stocks up this morning, commodities mixed with industrial metals leading, crypto up, dollar down, global bond yields up, a little bit of reflation heading into OPEX. Market moving headlines this morning. You have cash levels among investors hit the highest levels since September 2001, according to the B of A Fund Manager Survey. That's their survey of prime brokerage clients with about $872 billion under management, assets under management. The survey also showed that hawkish central banks are the biggest risk to the markets, followed by global recession, with stagflation fears rising to the highest since 2008, we talked about all these things in our macro scouting report last Tuesday. Definitely go check that out if you have not. According to our models, according to our analysis, we are nowhere near the bottom of this bear market, either in stocks, crypto, risk assets broadly. Definitely check out slide 71 and slides 105 to 108 in that May 22 macro scouting report for more details on what I just said. Walmart down 7% pre-market, beating on sales. We got a 8.7% inflation, but it's profit miss, and this is something we talked about ad nauseum in that presentation in terms of our bearish below consensus outlook for corporate earnings, corporate profitability. We've seen nothing yet as it relates to the guide downs and the markdowns on consensus earnings estimates that it's likely to come in the next 2 to 3 quarters. So check out slides 79 through 97 in that May 22 macro scouting report for those of you who want the details on that. Today we have Jerome Powell speaking. He's sort of heading a slate of Fed officials speaking today. You got Patrick Harker, Neil Kashkari, Loretta Mester, Charles Evans. Expect Kashkari and Evans to be a little bit leaning on the dovish side, but still very much corroborating the consensus view of the Fed that they need to get back to neutral pretty quickly. Obviously, we heard from Powell a couple Wednesdays ago saying that they're comfortable going beyond neutral as well. Check out slide 109 in that macro scouting report for our core PCE and core CPI analysis in terms of what our models are suggesting when the absolute earliest the Fed can afford to pivot dovishly. And guess what? It's definitely not today. So we are still very early in that process, or not early, but certainly middle innings in that process, according to our analysis and our quantitative projections on the inflation rates. And then shifting gears across the pond, the ECB's Klaus Snout, he said he supported a 25 basis point rate hike in July, and he also said a bigger move may be justified if inflation worsens. Recall that the ECB only has an inflation mandate; they are less concerned about growth only through the impact of growth upon obviously inflation. He said that normalizing monetary policy is the only option. So really piggybacking on the real sea change that we've seen from Christine Lagarde, Madame Lagarde, who runs the ECB, and a lot of the ECB governing council members in recent months. Our thoughts on the European inflation shock, the outlook for European growth, and ultimately the outlook for ECB policy are very clearly laid out in slides 11 through 15, 92 to 93, and 111 in that May 22 macro scouting report. Again, definitely go check that out to the extent you have not reviewed that. Arguably the best piece of research I've put out in my career. Big movers this morning. Obviously, we're going to get a lot of hawkish Fed speak and a lot of hawkish ECB speak this morning. So you have a 1 year, 1 month overnight index swap forwards up 7 or 9 basis points day over day. Whether you look at U.S. dollar contracts, euro contracts, British pound contracts, these are swaps on the expectations for the policy rate in these economies. So moving towards incremental policy tightening at the margins. S&P 500 up 2% to only down 7% month over month. Again, heading in Friday's OPEX. Obviously, you know the drill there. MSCI Emerging Market Index plus 3% to only down 6% month over month. And then you have Bitcoin and Ethereum up. I thought it's pretty interesting that they're underperforming the equity indices, which tells you a lot of what we're seeing today is not truly risk on, but really the unwind of dealer delta hedges from a short gamma perspective. So Bitcoin and Ethereum only up 1% and 2% respectively. Again, underperforming equity indices. They're down 29% and 36% respectively since we booked gains in those cryptocurrencies in early April. So unfortunately, if you missed that signal, you're free to subscribe and don't miss the next signal, because we're obviously going to find an opportunity to buy those in the coming months, if not quarters. And we're definitely we don't want you to miss those very opportune signals to manage risk in both directions, because guess what? Risk works in both directions, both to the upside and the downside. Taking it to the charts here. Before I get into the volatility adjusted momentum signals and probable ranges, I just wanted to add some historical context to this B of A Fund Manager survey. So it's always important when you hear a macro data point, particularly a data point that is going against your positioning, Obviously, if those of you who are watching the program, most of you have been paying attention throughout this year and have not suffered a major drawdown like 42 macro clients. We're certainly sitting pretty here relative to the herd. But the reality is you never want to take a data point and say, oh my God, I got to do something else. No, contextualize the data point, pull the time series back. So fortunately, we were lucky enough. Bloomberg provided this chart from the B of A Global Fund Manager Survey. And the one thing I would say is, hey, obviously, so that you're correct that we're highest since 9/11 in terms of the total amount of cash balance. But then I look back and say, okay, is that a buy signal historically? Obviously, it was a buy signal in April 2020. I pivoted bullish back in April 2020. Unfortunately, I was not able to convince my boss to do so. October 16, we pivoted bullish in November 16 as well. June 2012, right before QE3, that was obviously a buy signal. I think the market bottomed in July of that year. December 2008 and July of 2000. So when this thing peaks on a cash basis, are these always buy signals? And the answer is absolutely not. If you're in an actual bear market and not just dealing with macro event risk, which is what we've been dealing with in this post-crisis central bank balance sheet expansion era. So let's take it to the charts. This is the 2000 and 2002 S&P 500 bear market. And remember, this B of A fund manager survey peaked in July of 2000. And so I did the math on like, hey, if that was at a buy signal when the B of A fund manager survey said everybody's raised cash, go buy stocks in July of 2000, absolutely not. The market was down 46% from July 2000 to its ultimate low in October 2002. Let's look at the October 2008, December 2008. Go back and look at it from there, down 30%, 30% to the ultimate low in March 2009 from that signal. So it's telling you that this is not always a buy signal, particularly again when you're in a structural bear market. And oh, by the way, this bear market was very different than this bear market. This was a global financial crisis and one of the deepest recessions in U.S. and global economic history. This was the smallest recession in U.S. economic history, spanning March 2001 through November of 2001. We only declined 70 basis points, peak to trough in output terms. So you can get a nasty bear market. I mean, down 50% almost in 2000, 2002, down 57% in 2007 to 2009 from very different circumstances, because again, it's not just about recession, not just about the dang B of A fund manager survey. You got all these different cycles working against you: the profit cycle, the liquidity cycle, the inflation cycle, growth cycle. Obviously, you have to understand where you are in each of these cycles to ultimately understand where you are from a market topping process or from a market bottoming process. And again, we reiterate that we are nowhere near the market bottoming process concluding. Shifting gears back to our VAMs and probable range analysis, U.S. dollar index, bullish VAM still minus 0.4% of downside versus 2.5% of upside. So that correction in the dollar is almost over there, in our opinion. Gold neutral VAM still a little bounce this morning, 1.6% of downside versus 5% of upside in its probable range. 10-year nominal treasury of bullish VAMs, minus 9 basis points of downside versus 38 basis points of upside. So right now is the time to really start to study bond yields. Will we get that bounce off the lower boundary of the probable range, and do we see new highs, or are we going to start to make a series of lower highs into the peaking and rolling of inflation and ultimately the growth that's faster than anticipated growth slowdown that our models can currently project for the next several quarters? High yield OAS, bullish VAMs, minus 33 basis points of downside versus 43 basis points of upside. S&P 500 bearish VAMs, minus 8% of downside versus 3.6% of upside. Take it to 4,200. Why not? I would love to short stocks and short other risk assets at 4,200 at the upper boundary of our probable range. I mean, I would love to see that into an OPEX. VIX neutral VAMs, minus 16% of downside versus 45% of upside. NASDAQ 100 bearish VAMs, you got minus 10% of downside versus 5.5% of upside to a little over 13,000 there. That'd be the level to start the reshort digital economy names. Russell 2000 bearish VAMs, minus 9.9% of downside versus 4.4% of upside to around 1900. That'd be the level in the Russell to start, sort of the cyclicals and the real economy names within the U.S. equity markets. Bitcoin and Ethereum bearish VAMs, decent, a little bit of bounce, not a ton of bounce. Minus 17% of downside, 15% of upside for Bitcoin, minus 18% of downside versus 23% of upside for Ethereum. Shanghai Composite bearish VAMs. Now it's officially overbought with minus 7.4% of downside. We've been talking about China the last few days. Go check that out in terms of our thoughts on there, our expanded thoughts on there. WTI crude oil almost overbought here, minus 16% of downside versus 2% of upside. Agricultural neutral VAMs, minus 6% of downside versus 0.6% upside. So at the still correcting from the upper bound of its probable range there. Industrial metals, neutral VAMs finally getting a little bit of a bounce, still exhausted to the downside with 8.6% of upside. This thing is, it's teetering on the edge of breaking down the bearish VAMs. Doesn't have to break down today. Doesn't have to break down tomorrow. And this is what I tweeted about first thing in the morning at 4:40 in the morning. Have patience. I've never seen an asset market do this or do this. You don't get these. Asset markets are cyclical. They dance, associated with positioning, data, commentary from central bankers, commentary from fiscal authorities, geopolitical risks. They're going to go where they need to go in terms of the growth, inflation, profits, and liquidity cycles. But they're not going to go there in a straight line, in a straight shot. So just be patient. You haven't had an opportunity to sell and raise cash. Give it a few more days, maybe a couple more weeks to give yourselves an opportunity to raise cash and sell into strength at higher levels. That's how this game is played professionally, and we want you to be playing the game at the highest level as well. So with that, Darius Dale presenting our macro minute for Tuesday, May 17, 2022. I know I went a little bit over this morning, but I'm guessing you enjoyed the extra content. So catch you back here tomorrow. Cheers.